In 2022 on Twitter, an account impersonated the verified account of Eli Lilly and announced insulin would be free. And how did the market respond to this?
Electric chair.
Hey guys, thank you for tuning in. Good morning, good afternoon, good evening from whenever you're watching. And if you're watching from the distant future, go buy my merch. I'm sure in the future I have merchandise out and it's pretty amazing, so go buy my merch. Last week, after 5-ish years or so, I uploaded a video and lost subscribers. Yeah, people were in effect paying me to not upload videos. Encouraging. The stock market, private equity. I feel these things people paradoxically know everything and nothing about at the same time. I'm not sure what I'll title this video as yet, but I wanted to visit how the stock market actually works and what does it mean for the society that we've built. I've noticed a really concerning trend and direction we're heading, and I don't really hear persons talking about it. The stock market really materialized in the 1600s with the Dutch East Indian Company. They wanted bigger expeditions and projects, and as a way to fund it, they issued shares, as in your share of the company. This was issued to the public and it was tradable. Then one by one, other companies followed along, and before you know it, the stock exchange as we know it today was created. Now, real quick. Share represents ownership in a specific company. For example, owning, let's say, 5,000 shares in SpaceX. But stock represents a portfolio of sorts, different shares in different companies. It's more of an umbrella term. Then there is stake, which represents ownership percentage of a specific company. Now, how does this work today? It has gotten more complicated due to the addition of regulations, but in practice, it's fundamentally the same thing. When you go to a trading platform, you see the prices move up and down, and you can buy shares, almost like betting at a casino. Thing is, there's a much more complex process happening in the background. The trading platform practically functions as a simplified broker in real time. The price that you see is actually the last traded price, meaning it's the last price someone agreed to sell their shares at and another person agreed to buy those shares at that cost. You do have the option to trade at the current price, or you can put in an order to buy when the trading price reaches your desired price. And when the trading price reaches that number, or in other words, when someone is willing to sell for the price that you want to buy, you then acquire the shares at that price and now set the trading price for those shares. For example, say you want to buy shares in a company because you believe the company is valuable and will be more valuable in the future. You review the company details, earnings, profits, assets, projections, etc. And you're willing to pay $10 for one share. That's what you think the company is worth. But you notice that the last trade was at $8 for one share. Then you're likely to buy a healthy amount of shares at $8, which is less than the $10 you were willing to pay. In your eyes, you saved money, you got in before the rise because the share is undervalued. As more and more people catch on, they too will want to buy the company shares. This means the demand for the share gradually increases because more people want the share. The people who already have shares realizes this and decides, well, I'm not selling my share for anything less than $15. Now, as less and less share becomes available to buy, someone finally agrees to buy at the $15. And so now the stock price moved from $8 to $15. To be fair, buying and selling happens millions of times per day for liquid stocks, so this number fluctuates within the milliseconds. And yes, if someone buys shares 2 weeks ago and there is no trade, but you decide to buy shares today, the price that you will see will be the price that was traded 2 weeks ago. This usually happens with illiquid stocks. It is important to note that, first of all, this system is based entirely on belief and choice. And we'll get back to the choice component in a bit. There's nothing beyond two people agreeing to trade stocks at a certain price. But the second part of this is that there are those who are incentivized to keep the share value high and always growing. The people that own shares are part owners of the company. When a company decides to let its share trade publicly, most times the money doesn't go to the company, unless the company wants to raise more money and decides to create new shares. People buy those shares and that money goes to the company. Otherwise, the money that's being traded just moves between buyers and sellers. But here is where things get especially interesting. The company's executives have a fiduciary duty to their shareholders. They're obligated to do whatever they can legally to ensure that the shares are always attractive. Otherwise, shareholders will sell their shares. While this doesn't affect the company's income and finances directly, it can reduce how the company has access to financing. This happens in a few ways. If the company wants to raise money by issuing new shares, the company will find that difficult because no one values the shares. Additionally, the company may have issues accessing additional capital to grow. This is because most companies use the value of their shares as leverage for different forms of financing, completing acquisitions, etc., instead of using their own cash. This is where things become... Going back to the earlier examples surrounding Eli Lilly, investors were more concerned about the company's profitability than a life-saving product being more accessible. VC firms are notorious for acquiring companies and taking them through hell, just so the company can make an IPO and the VC firm can make massive returns on their investments. Fact of the matter is, this whole system is built on belief. The market isn't quite this mystical sentience it's portrayed as, and this applies to the general way we engage with products and services, of which I'll make a separate video about, but bottom line is, it's all about choice and trust. To be clear, I believe in capitalism. I think it's the best system yet to push our species forward. But what is happening here isn't quite capitalism, or at least the way it started out to be. Instead of acquiring capital to foster meaningful development, think the first iPhone, Amazon, or Microsoft when they first started, or even Visa. These are ideas that fundamentally changed our access and standard of life. It's now about acquiring capital to benefit self in the relative short term, which leads to hoarding and the adoption of shallow methods prioritizing convenience and short-term gain over consequences. What the collective doesn't always realize is that each movement represents a story, and these numbers are driven by people. People who have agency, desires, stress, anxiety. Every increase in profit can represent a sales rep working a little harder to get a promotion because maybe they have a family to take care of and they want a larger apartment. Or sometimes the easy way out is chosen by gutting entire departments. On the big picture, sometimes the humanity is lost. So now what we have in practice is a system that disincentivizes making things like healthcare more accessible because apparently it doesn't guarantee enough money for a few to be able to afford fancier vacations. Let me know your thoughts in the comments below and subscribe to the channel if you want more videos like these. Thank you for watching and enjoy the rest of whenever you're watching.